we had you on a little bit ago, back in December. You gave us your S&P price target. Now you've raised it. You gave us a range, actually, 5,200 to 5,500. So tell us, what changed and what needs to happen to get us to the high end of your estimate of 5,500?
Yeah, sure. So that was before earnings came through, and U.S. earnings came through a little bit stronger than we anticipated. So that made us take up our base case. And then, look, this continued strength of the U.S. economy and the potential for what we're seeing on the AI side is also making us think about a kind of Goldilocks scenario coming through. And I think there's a couple of things there. First, global investors still remain kind of underallocated to the United States. Globally, we have a tremendous amount of cash on the sidelines, and we still think that inflation is going to fall and that the Fed and other central banks are going to start to cut rates. So those are some of the things that, if they play out favorably, can take us toward that upside surprise and kind of a bull case scenario.
Okay, so that's your Goldilocks scenario. You just laid out the three things that you need to happen to hypothetically get us to that 5,500, which would be another double-digit rise on the S&P for this year, following a big rise last year. So I do want to ask you, what's your take on mega cap tech? Our CNBC data team, they gave us a great nugget. Year to date, 52% of the gains on the S&P 500 are from those AI-focused stocks that you were just talking about. So right now, when you talk to clients, do you continue investing in the Magnificent Seven in this mega cap tech trade? Do you trim? I mean, what do you do?
Well, we've been looking at this and we've been positive on it. And I think an important statistic is that we see AI revenues growing around 70% a year through 2027. Now, the stocks are expensive, but we don't think they're necessarily in bubble territory. And again, with so many investors actually underallocated, for many of our clients, the recommendation is not just to hold their positions, but to add to them. But of course, around that, we'd like to position for some of the other aspects that can come through in a Goldilocks scenario. And that might include something like U.S. small caps.
You're leading me right here, Mark. I'm going to ask you, because I'm going to be asking a lot of people that come on. A lot of people come on, they say, small caps. Then we ask, why invest in small caps? And usually the answer is because they're lagging. But I'm looking at small caps year to date. They're way behind the S&P. What's the case for small caps for you right now? Because they just don't seem to ever want to catch up.
Yeah, it's been a tremendous divergence that's persisted for a long time. I think what you're seeing there really is a reflection of the expectations about the Federal Reserve being put off. Now, we do see the Fed cutting. We see them cutting 75 basis points this year, probably starting in June. And this is after reflecting on some of the stronger data that's come through. That's what's holding the small caps back, because people are afraid of those refinancing costs for the small caps. And if some of that pressure comes off, they're well positioned to close that gap. And yet, yes, there is a gap. It's 30, the
huge
P ratio, it's about 30% to the S&P 500.